Okay, we are recording. So hello again, everyone. This recorded lecture is going to be for chapter 1. So we're going to go over the chapter 1 PowerPoints together, and we'll see some examples of what we'll be doing in class together, and then the exercises and problems that we do in class together, again, will reinforce what is being discussed or what is being shown in these chapters. So very important to watch the recorded lectures, very important to read the chapter, but then also watch the recorded lecture. That gets you participation points on the syllabus and for your grade. So 10% of your grade is participation points. So make sure you watch these lectures. There are only going to be 7 of these recorded lectures throughout the semester. I did one already for teacher introduction and then going over the syllabus together. And now this is for chapter 1. And in Principles of Accounting 1, your book has 12 chapters. In Principles of Accounting 1, we cover 6 of the chapters, and then Principles of Accounting 2, we cover the subsequent 6 chapters. So there'll only be, 6 chapter recorded lectures for the PowerPoints that you'll need to view. So otherwise, again, class time is going to be focused on getting hands-on practice and going through these exercises together. So anyway, I'm going to share my screen with you and get this PowerPoint pulled up. Okay, and let me go full screen here on this. Okay, so chapter 1, we're basically getting an intro into accounting and then looking at some of the different accounts that we have, and distinguishing, again, between some of these different accounts, assets, liabilities, equity, revenue, expenses. Those are kind of our main account categories. So anyway, we'll be looking at an intro to accounting, and then again, kind of learning some of the attributes and distinguishing between these different types of an account. So basically, accounting can be divided up into 3 major functions. So identifying, recording, communicating. So in the identifying phase, or the identifying function, we as accountants are looking at and zeroing in on or identifying which accounts or which transactions, which business transactions are going to affect us monetarily, or which business decisions are going to affect us monetarily, right? Basically, which of these transactions are going to affect our financials, affect our financial statements. So, as you could imagine, there are many decisions made within an organization that do not necessarily affect our money or affect our financials. So as accountants, we want to identify which transactions and events need to be recorded that are going to impact our financial statements and impact us monetarily, okay? So function number 2 is the recording function. And so this is when we're actually recording these transactions in our accounting system, doing the journal entries, doing the debits and credits, keeping the general ledger accounts and the logs, and looking at the transactions and recording the amounts and the dates and all this jazz, right? This is the recording function. This is also known as the bookkeeping function, right? And then, and really we look at, so in chapter 1, we look at how these transactions impact that basic accounting equation. But it's really in, and I can't remember, I think chapter 2 that we start actually getting practice with the journal entries. So anyway, communicating function. So the communicating function is, once we're at the end of the accounting period and we've closed our books, we've prepared our financial statements. Now we're looking at these financial statements, maybe we're analyzing these financial statements, and we are communicating about what happened in the business that period. What happened in the company that month, for example, or that quarter, for example, or that year, for example, right? We are communicating the overall financial impact or for that accounting period, right? So once we've prepared our financial statements, we're talking about them, we're analyzing them, we are in the communicating function. We're showing what happened in the business over that time period, right? All right, so the language of business, just like it shows here, you know, the accounting is oftentimes referred to as the language of business because, again, when we prepare our financial statements, we are communicating or showing or displaying what happened financially in the company that accounting period, right? So the language of business, right? How did we do? How much revenue did we bring in versus how much in expenses went out? What was our net income? What were our asset purchases? What are we doing preparing for the future? Well, you know, the accounting is the language of business because we are communicating about the future and the financial transactions and financial results of the company for a period of time, right? So we also talk about the difference between external and internal users in this introduction as well. You know, just like it shows here, or as you can, you know, imagine, maybe if you know the difference between external and internal, external users work outside of the organization. So external users do not work for the company or do not work for the organization itself. They are individuals outside of the company interested in the company's financial information. So just as a simple example, if I'm a small business owner and I go to the bank to get a loan, the bank is a lender or a creditor, and the bank would be interested in my financial information, right? My company's financial information to determine whether or not they want to give me a loan, yeah? So that's an example of an external user. Also, if you think about the IRS, right? Companies pay taxes based on their level of income, similar to how we pay our personal taxes, right? So the IRS is definitely interested in our financial information to know how much to charge us in taxes, right? So you think about that, you know, lenders, any external auditors, publicly traded companies, are required by law to be audited on an annual basis. So these are external auditors that come in and basically check their financial transactions and check to make sure that they're following generally accepted accounting principles and that what is shown in the financial statement actually represents what happened, right? That's what external auditors do. Shareholders in the business, board of directors, regulators, again, like the IRS, you know, customers potentially want to know how the company's doing. Investors, you know, you could say want to know how the company's doing. Stockholders, I know it falls into that kind of that category of shareholders. Stockholders are also shareholders, but shareholders could also include, for example, like a supplier. So, you know, maybe we want to place a large order with a supplier. That supplier would be interested in our financial information to know whether or not to give us credit, to know whether or not that we can pay that back and we can pay off this large order, for example. Shareholders could also be like people in the community, employees. They all have a share in what is you know, what is going on in the organization, right? So some of the external users. Okay, internal users, on the other hand, are people that work inside of the company, right? That work for the company itself. So these really include managers and people at a level that have access to the financial information. people that are interested in the financial information for decision-making purposes, right? I can tell you at the company that I worked for, and this is honestly why I really think that even for those of you not considering an accounting major, this is why it's so important to just understand the accounting side of it and where the numbers are coming from and the transactions and things. Because at the company that I worked for, every manager, so I know I can't rattle them all off the top of my head, but I know we had, our conference manager, Becky. We had a marketing manager, and now her name escapes me. But anyway, we had a IT manager. We had an HR manager. We had a membership manager. So each subunit or each part of the business that had their own manager, right? Every month when we would prepare our financial statements, each manager would be given a copy of the financial information related to their particular department, to their particular unit of the business. So, you think about the conference manager. Well, the conference department brought in revenues by holding these large conferences where manufacturers and distributors came together at the conference, and there was networking and there were different events and stuff like that. So the conference department brought in revenue by selling these registration fees, or the registration fees for the events, selling tickets for these events and stuff. And then they also incurred expenses by, the individuals that worked in that department. Certainly their salaries as an expense. They also had supplies that they used. They also, at some of these conferences, paid, outside speakers to come in and give a presentation. So they had speaker fees. They had printing fees, postage fees, all different kind of fees or expenses that went in with it. So each manager received a copy of the financial statements that related to their department to make decisions in their department, right? So even if you are not planning on going into accounting per se, if you ever have a goal of being at a higher level within a company, a management position, you do have to understand where this information comes from and how to read it. So nonetheless, accounting's awesome, right? All right, here we go. All right, so some of the different opportunities in accounting. Of course, I'm not going to read through every single one of these, but again, many different opportunities available in accounting. Virtually 0% unemployment in the accounting field, because as you can see here, many different opportunities within accounting. Well-paid positions, positions that people can be proud, right? Like, I'm so proud to tell people that I'm an accountant, right? Like, it's, I feel a very special thing. There's not many of us that love accounting, which is, a good reason why there's so many positions available in accounting. But nonetheless, definitely a field when you graduate college, you get a job, boom, you get a job right away. I'm snapping my fingers. You get a job right away when you go to school for accounting, because many different opportunities available. So, all right, so some of our assets. So just like it shows here, assets are properties or other things of value owned and controlled by an economic unit, also known as a business entity, also known as a company, right? Also known as an organization, right? So assets companies use assets to generate revenue, basically, all right? We use our assets to make money, to generate revenue. Revenues are the money that is earned by an organization over a period of time. So we might we might prepare our financial statements every month. In that case, we're looking at what revenues came in that month, essentially, right? Revenues minus expenses equals net income. And that's really the bottom line of an organization. What did that organization earn? Net income, right? Bottom line of the income statement. So anyway, we use our assets to earn revenue. Okay, so some of these common asset accounts: cash, accounts receivable, notes receivable, prepaid accounts, supplies, equipment, buildings, land, right? These are all examples of asset accounts. So we'll go through and talk about each one of these just a little bit. But again, as we continue through these chapters, we're going to get a lot more familiar with these. So accounts receivable, this is when our customers owe us money. So accounts receivable, we have performed a service or provided a product, provided a good. We've performed a service, we've provided a good, and the customer hasn't paid us yet. So that's an accounts receivable. That's money that we expect to receive for a service or a product that we have already provided to the customer, okay? Notes receivable is along those same lines. Notes receivable is money that we expect to receive, although this might not be necessarily from a customer. For example, we could have, maybe we made a loan to another company. Maybe we have a business agreement, or we made some kind of loan, or we provided, something for another company. And now we have this long-term, or I mean, it could be short-term also, but basically an agreement that says, this individual is going to pay us X amount per month for so many months until the debt is satisfied, basically. So a notes receivable is a more formal, generally speaking, has multiple payments attached to it. And usually we would also collect some interest on the note. So if you've ever heard the term promissory note, we would have this person or this business, for example, sign the promissory note, and that would say that business promises to pay us, again, X amount over a period of time. So whereas accounts receivable might just be, we could think of 1,000 different examples, but maybe we cut a customer's lawn. Maybe we're a lawn service, and we cut the customer's grass, and now they owe us the money, right? That's an accounts receivable. Whereas a notes receivable is maybe we have a contractual agreement that we go and cut this business's grass every month, and they pay us X amount over the year, over time, type thing, right? A more formal agreement, if you will. Okay, prepaid accounts. These are like if we prepay for rent, for example, if we rent an office building, we might pay the rent 6 months in advance. That would be a prepaid account. Another example is like prepaid insurance. So if we buy a 1-year insurance policy, that is a prepaid expense for us, or a prepaid account, because now we've paid our insurance expense for an entire year. So we have that available to use for an entire year. That's an asset to us. We've prepaid that expense. Supplies, equipment, equipment could include, fax machines, copiers, any type of assembly equipment, maybe in a factory. Equipment could also include vehicles. If we have maybe a fleet of trucks that are used, or maybe a van or something that's used in our business, those are types of equipment, right? If, using the example of the lawn care service, certainly the mowers and weed eaters and all that good stuff would be considered equipment, right? Okay, buildings, land, again, assets, we use assets to earn revenue, right? So to help us earn revenue. So if we have a piece of land that our building sits on, we're using that office to conduct business, to earn revenue. We're using the equipment and the supplies within the office to, again, earn revenue. We've prepaid some of our expenses in advance because, again, we know we're going to be doing business. We're trying to earn revenue. We've just prepaid that in advance. Receivable accounts, those are presumably for services or products or goods that have been provided, now we're owed for. And then, of course, our cash account, which, you know, cash account is the account that is impacted or affected most often. And once we start looking at examples of these transactions, we'll see this. The cash account kind of always has the most ins and outs in it, right? That's how we pay our expenses and things like that. So anyway, all right, liabilities. And actually down here now, it's showing us, this is the basic accounting equation. We're going to talk about this more as we go through the PowerPoints, but this is our basic accounting equation. Assets equal liabilities plus equity, okay? Assets equal liabilities plus owner's equity. So liabilities are the debt, and that's what it shows here, right? Liabilities represent debt, and they are essentially the creditor's claim to the assets, okay? So what would happen, you know, in the case if a company had to go out of business for whatever reason, and so what they would do is they would sell all their assets, pay off their liabilities, and whatever's left over would be the owner's to keep, the owner's equity, right? So then that's what it shows here on this second bullet point. The creditors claim to the assets, and they have priority over the claims of the owners. Because again, if a company was going out of business and had to liquidate, had to sell off all of their assets, they would sell their assets, they would liquidate their assets, and then we'd pay off all of our liabilities. And what would be left is that owner's equity, or the part that the owner gets to keep, right? And so just like it shows here, liabilities can arise or can originate because a business bought goods or services. So we bought goods from a supplier, or we bought, you know, services, you know, maybe cleaning service or maintenance service or something like that, right? Like we bought goods or services on credit, could be one way a liability is created. We borrowed money from the bank or from a lender, that's another way a liability is created. Or, you know, just overall, whether it's bought goods or services on credit, borrowed money, but we've created an obligation to pay. We now owe money, right? Okay. All right, so here's some of our different liability accounts, accounts payable, notes payable, unearned revenue, accrued liabilities. I mean, we could sit here and think of so many more than this. This is a pretty basic list, but, you know, just to throw out a few, we could also say, you know, sales tax payable. We could also say, for example, we've got accounts payable, we got notes payable, salary and wages payable. We could also say interest payable, right? So we can have some of these different accounts. These are just kind of giving you basic overview. So accounts payable, again, bills that we owe. And so the way it works generally, you know, this is kind of the basic way it works, no matter what type of accounting system that you're using. But if you know, at the company I worked for example, how we did it is we would get invoices or bills in the mail. And then so as soon as we got the bill in the mail, we would record it in our accounts payable system, and we record it according to the date on the invoice, the amount on the invoice. And then we have to record a code, an accounting code to it, that represents what type of an expense it is. So again, if we received a bill for supplies, then we would record it with the supplies expense. Or if we received a bill for insurance, then we would record it with that appropriate expense code. Or if we received a bill for taxes, we would record it with that appropriate tax accounting code, right? So we receive these bills, we receive these invoices in the mail, we enter them into our accounts payable system, and they stay in that system until we cut checks for it, at which time it moves from now we've paid the bills, so it's decreasing our cash, decreasing our accounts payable. And again, we're going to see examples of this when we start looking at the transactions, but that's traditionally how it works. Every company is a little bit different. So at the company I worked for, we paid bills, or we cut checks every Friday. So all week long, you know, we're entering an invoice into the AP system, we're entering invoices, we're entering bills into accounts payable, and then Friday we cut checks. So that's essentially when all of our accounts payable accounts are paid off, right? I know at a company I worked for previously, they only paid their bills once a month. So AP, or accounts payables, would you know, basically accrue or sit in there for 1 month, and then once a month we would cut checks. And if we got, say we cut checks on the last day of the month, whether that's the 30th or the 31st or whatever, say we cut checks on the last day of the month, if we received a bill on the 1st, the next day, then that one would wait till the last day of the next month, right? I mean, if you miss that cutoff, we don't cut interim checks, basically, you know, once a month is when we cut checks. So every company does it different, but again, that's what accounts payable are. Bills that we owe, right? Okay, notes payable are also debts that we owe. But again, with a note, it's a more formal agreement. So, you know, I don't know how many of you at this point in life have had a car payment yet. Maybe some of you never have had a car payment yet, and that's okay. You're young, right? But that's another term for like a car payment, is like a car note. So you pay X amount per month to the finance company, or to the lending company, to the lender, for X amount a month. So for example, your car payment might be $300 a month for 48 months, for 4 years, that type thing. That's like a car note. So it's a more formal agreement to pay off X amount over time, right? Just like, you know, conversely, or similarly rather, you know, with the notes receivable. Notes receivables, money we expect to receive, and we have a more formal contractual agreement on that note receivable. Same thing on note payable. Note payable, money we expect to pay, but there's a more formal agreement. It's not just, you know, going to get paid off at the end of the month. It's going to be multiple payments over a period of time, a more formal agreement type thing. Okay. Unearned revenue. Unearned revenue is when our customers pay us in advance and we have not given them the service or provided them the product yet, right? So unearned revenue, customers pay us in advance. So we receive cash from them, we receive money from them in advance, but we still owe them a product or a service. So that's considered a liability, because it's an obligation to that customer. It's an obligation to some duty, right? To provide a service, or to provide a product, or a good, you know, something to that effect. So unearned revenue is a liability because we owe that. Okay. Accrued liabilities. So accrued liabilities could be, you know, for example, and this is kind of the most recent one off the top of my head that I can think of, that happened at the company I worked for. So we were implementing a new learning management system. We offered online training courses and stuff, and I worked in the nonprofit organization that dealt with electrical manufacturers, distributors, contractors, things like that. So we offered different training courses online for electricians and things like that. So anyway, we were upgrading our learning management system so that we could provide better training courses and better interactions with these online certification courses and things like that. And so we knew that this learning management system, you know, just to throw an easy number out there so the math is easy for me, we knew that this learning management system was going to be $36,000, right? And we knew that we were going to have to pay $3,000 per month over 12 months to do this learning management system, or to complete this learning management system, right? Is kind of how the money would break down. Now, maybe we didn't cut a check for it every month. Maybe we were only, we made an agreement with them. We were only going to pay them, 4 checks. We'd cut a check every quarter. So instead of cutting a $3,000 check every month, we would cut a $9,000 check at the end of the quarter, right? But for those 3 months, we would accrue that $3,000 liability, even though we may not pay it until the end of the quarter, or maybe we won't pay it until it's completely finished. Maybe we pay the whole $36,000 at once if we want to. That'd be fine too, for the purposes of this example, right? But again, even if we don't want to, even if we're not going to pay the entire $36,000 till the end of the year, we're still going to accrue a $3,000 liability every month, because we're breaking that debt up over the course of the period that we're going to have to pay for it, basically, right? So that's an accrued liability, something that we're going to have to pay, again, over, maybe once they complete 25% of the learning management system, we pay them 25% of the cost. Once they complete 50%, we pay them the other 25, some type of agreement like that. Okay. All right, so a creditor, I mentioned this earlier, if we went and we borrowed money from the bank, whatever we were borrowing for, maybe we were borrowing to buy a car, or maybe we're borrowing to buy another piece of equipment for the company, or maybe we're borrowing to make an investment in land, whatever the case may be, the company that we are borrowing from, the lender, is also known as a creditor, okay? So they are providing us with credit, and we have to pay that back, essentially, right? So here's an example of a transaction, how a transaction like that would be worded. So it says, an entity's assets consist of a truck that costs $35,000, okay? The owner has invested $12,000, and the business entity has borrowed the remainder from the bank. Again, the lender, AKA creditor, right? So we see how this would look on our basic accounting equation. So we own an asset that's worth $35,000. We owe $23,000 on the asset, which means our part that we've put in, or our part that we own, our equity that we own, is $12,000 of that. That's kind of how that situation looks on the basic accounting equation. And again, as we go further into this, and as we start getting practice with this, we are going to see that every transaction in a company affects this basic accounting equation in some way. Every monetary transaction affects this accounting equation in some way. All right, so equity. We mentioned this earlier. The equity is the owner's right, or the owner's claim to the business, or the owner's financial interest in the business, also known as capital. So capital is the owner's, part of the owner's equity, right? And so in the situation, if a company begins, let's say we began our company, or we're going to begin our company on August 1st, and we're going to invest $80,000 in the business. At this time, we have no debt, right? Assuming we have $80,000 in cash to invest in the business, we have no debt. At that point, this is what our equation would look like. We invest $80,000 in the business, so now we've got $80,000 in assets. We've got $80,000 in equity. Okay. Again, this is assuming we have no liabilities, because technically the basic accounting equation, assets equals liabilities plus owner's equity. This is assuming we have no liabilities yet, and that's fine. Just to show you what it would look like. Okay. All right, so our equity account. So we've got really 4 main equity accounts: owner capital, owner withdraws revenues and expenses. So when the owner invests money into the business, just like we saw on the previous slide, the owner invested 80,000 into the business. That investment into the business, we call that capital investment. The owner's capital investment increases equity, and that's why we see that plus sign here, right? Owner's capital investment increases equity. And it wouldn't even necessarily have to be a cash investment or a monetary investment like that. It could also be an investment of equipment, for example. But that's the owner's initial capital investment to get the business started. That increases our equity, right? Where'd my thing go? That increases our equity. Okay. Then if the owner takes money out of the business, if the owner withdraws money from the business, that decreases equity. Okay. When the business earns revenue, so again, we could think of 1,000 different examples here, but using the lawn care service example, when we earn revenue is when we mow the lawns and do the different lawn care things, weed eat or spray it with anti-weed chemicals or whatever, weed killer and grass grower and different stuff that we do. As we're providing those services, we're earning revenues, right? So that's the revenue that a company earns comes from the good or service that they provide. Okay. And that increases equity. Obviously we earn revenues, that increases equity. Conversely, when we pay expenses, that decreases equity. So, again, there's a number of expenses that we have every month. We've got telephone expense, utility expense, supplies expense, printing expense, postage expense, salary and wage expense, tax expense, several different expenses like that. And obviously when we're paying those expenses, we are decreasing the amount that we have, the equity that we have in the business is decreasing. And the goal is, and this is what is net income. When we think about net income, revenues minus expenses equals net income. So that's where we get the information for our income statements, taking our revenue minus expenses. All right, so here's an example. Again, that basic accounting equation, that fundamental accounting equation, assets equal liabilities plus owner's equity. And they're showing us here that as long as we're given two of these numbers, we can calculate the third, because the equation is always true, right? Like what assets equal liabilities and owner's equity have to equal. Otherwise, something has been recorded incorrectly. So it says, again, this is the equation expressing the relationship of assets, liabilities, and owner's equity. So we see here, if we have 50,000 in assets, we have 12,000 in liabilities. Again, looking at the difference between these two, we can calculate owner's equity. Owner's equity then has to be 38,000, right? To make that equation true, owner's equity has to be 38,000. Yeah. Okay. All right. So at this point, if we were able to do this in class together, then we would stop, we would take a break, and we would do exercise 1-1, 1-2, 1-3, and 1-4 out of the end of your chapter. These are all on page, and I'm looking at it for you right now. These start on page 38 of your textbook, 38 and 39 of your textbook. I would encourage you, again, because we are going to have limited time in the classroom together, I would encourage you to try these quick exercises independently and make sure you have a good understanding of this stuff. I'm actually going to be giving you guys, I'm going to be posting it in OwlNet, the solution manuals after we're done going over a chapter, so that you're able to see, you know, if you have a good grasp on you'll be able to see all the exercises to make sure you have the answers to all the exercises to make sure you have a good grasp on the material. Okay. All right, so we talked about recording business transactions when we talked about our accounting functions. And again, we really get more into practice in the journal entries in Chapter 2 and Chapter 3, but we will look at how each of these transactions affects the basic accounting equation. Because again, you think about that accounting equation, it's showing it to you again here. Assets equal liabilities plus owner's equity. Every transaction in a business affects this accounting equation. So where we're going to start, before we actually start getting into the journal entries and the debits and credits, we're just going to look at how each of these transactions affect the accounting equation. We're going to go through this pretty quickly together because I feel like I've been yapping for a while already, and I'm trying not to make these too long, but I do love talking about accounting, so I can go on and on about it. But anyway, we're going to look at how these transactions affect that accounting equation. And in fact, the first day of class, I'm going to have a little exercise that we can kind of do together to get practice with this as well. So anyway, it's showing us here the business entity concept. You guys have I know a question on your first exam where you have to know the definition of this business or this separate entity concept. And basically it just says that we need to keep entities separate from one another. So in the case of like a sole proprietorship, for example, we would want to keep the expenditures and the revenues of the business separate from personal expenditures, right? We want to keep personal information separate from business information, right? They're two separate legal entities. Or in the case where maybe someone had two businesses, maybe someone had, for example, and I know we keep using the lawn care service. We'll think of another example in the next chapter, but maybe someone had, you know, a lawn care service that they owned, but then they also had a different business where they sold, you know, flowers and bushes and trees, maybe like a nursery also, you know, so they maybe would want to keep those two separate, right? Those two businesses separate. Maybe they want to combine them. I don't know, just giving an example. All right, so some of the steps that we look at in analyzing this transaction, again, we want to be able to read the transaction. We want to know what's being affected. Are assets being affected? Are liabilities being affected? Is equity being affected? And then making sure, again, that once we record this transaction, that accounting equation is remaining balanced, right? All right, so here's our first example. Again, I'm going to read through these pretty quickly because I know we still got a number of slides to go. I want to make sure we can get through them in this lecture. So the owner deposited $90,000 in a bank account in the name of the business. So again, the owner's investing in the company. So then we're increasing our cash, which is an asset. We're increasing cash, which is an asset. We're increasing owner's capital, which falls under the equity section, falls under owner's equity. All right, company bought equipment, paying cash, $38,000, okay? So both cash and equipment are assets. So we're purchasing equipment, equipment's going up, we're paying cash, cash is going down. So the way that this would look, cash goes down $38,000, equipment goes up. So we've got a negative to cash, a positive to equipment. So it's just the asset side of the transaction being affected in that one, or the asset side of the equation rather being affected in that transaction. Company bought equipment on account from Signal Products, 4320. We're going to get to know this word very well, on account, or this phrase, on account, on credit, on account, which means we did not pay cash like in the previous example. We purchased it on account, so now we owe for it. Now we've created a debt. All right, so now we've got equipment going up, 4320, but then also what we owe is going up, right? Now we owe 4320. So that on account, basically on account, on credit is just, we're not paying cash. Now we owe for that. All right. Company paid Signal Products a creditor $2,000 on account. So we purchased it back here. We purchased equipment for $4,320. Now we're making a $2,000 payment. Excuse me. So again, I know some of you are at the point in life where you have not had a credit card yet, and that is good. Credit cards, they serve a purpose, but they can easily get somebody into trouble. So I'm not saying that's a bad thing, but I'm not saying that's a bad thing to have a credit card, to use a credit card. But what it's showing you here basically is like if we made a credit card payment. So we owed $4,320 on this, and now we're paying $2,000. So what's going to happen? Just like if we paid a credit card payment in our personal lives, our cash would go down, but then also what we owe goes down. So we've got a negative to cash, a negative to AP. All right, an owner invested equipment with a fair market value of $5,200 in the business. Again, equipment is an asset. So equipment is going up, as we see here. And just like when the owner invested this $90,000 cash, now the owner's investing $5,200 investment, capital investment. And again, that additional investment increases owner's equity. All right. And I haven't said this yet as we've looked at these examples, but you can, go back, you can flip back and look where this accounting equation remains in balance after every one of these transactions. Has to. Otherwise, something was recorded incorrectly. All right, at this point, we would have stopped and completed exercise 1-5, 1-6, 1-7, 1-8. I would encourage you to do these individually. We might get practice with some of these in class together, but I would encourage you to do these individually and make sure that you have a good understanding and feel comfortable with the material so far in Chapter 1. Okay. Revenues. So we've talked about revenues already. Revenues are what the company earns from providing goods and services. So just like it shows here, fees earned for performing services, income from selling merchandise, rent income for the use of property, interest income for lending money, and just like it shows here, for companies that accept credit cards, revenues can be in the form of cash or credit card receipts, or they could be in the form of accounts receivables, right? So we earn the revenue, but we've got to send the customer an invoice and get paid. So accounts receivable or receivables in general are other types of revenues also. All right, expenses. Again, expenses, these are, basically the bills that we have to pay each month or, over time. So expenses will include things like rent expense, supplies expense, utilities expense, maybe telephone expense, cleaning service expense, maintenance expense, gas expense, tax expense. I don't know if I already said insurance expense, but again, there's several expenses that a company has to pay to be able to do business, right? To be able to stay in business and earn revenue. Okay. So it lists some of them here. Again, I just kind of went through these. Wage expense for labor performed, rent expense for the use of property, interest expense for the use of money, advertising expense, utilities expense, telephone expense, again, expenses. All right. And remember, and I said this several slides ago, we calculate net income in the business. And remember, net income is a really important number. That's the bottom line. What did we earn? That's our revenue minus our expenses equals our net income. All right. So now they're showing us that basic accounting equation, kind of with that owner's equity section drilled down on to show you what that includes. Member assets were the accounts like cash, accounts receivable, supplies, prepaid expenses, building, land, equipment, Liabilities, these are the bills that we owe, accounts payable, notes payable, unearned revenues, accrued liabilities, taxes payable, you know, we could think of several. And then kind of how that owner's equity account drills down. So remember, when the owner makes an investment, that increases equity. That's considered a capital investment that increases equity. When the owner withdraws money or takes money out of the company, that's an owner drawing or an owner withdrawal that decreases equity. When we earn revenues from providing goods and services, that increases equity. When we pay expenses, that decreases equity. All right, so here's an example of a chart of accounts that a company might use. So the chart of accounts would include all of the accounts and their account numbers. And I kind of mentioned this earlier, and we'll talk more about this as we go through the textbook, but when we record these transactions, you know, when I'm, for example, if I'm doing a journal entry and the journal entry is affecting cash, I don't type in cash. I type in this code, 111, and it pulls up that account. It populates the cash title, right? So I would use that account code, right? So the chart of accounts, and this is a multiple choice. You need to know essentially what the definition of chart of accounts is. And the chart of accounts is an official list of accounts tailor-made for the business along with the account numbers that it goes with, right? All right. So here's another example. Company received a bill for an expense, $620. So we just received the bill. We didn't pay it yet. We just received it. So just like the example I gave you, we enter that into our liabilities, our accounts payable system. And then when we pay it is when it actually decreases cash. But when we receive the bill, we're recording, now we owe it. So we're recording the expense. This is advertising expense, 620. So we're recording the expense and now we owe. We're recording the liability. We're recording accounts payable. So expenses are going up, right? We're increasing our expense. And then also what we owe is going up. All right. Connor's Whitewater Adventure provides 27 one-day rafting tours and bills Crystal River Lodge for $6,750. So, excuse me. Now we're earning revenue. We're a whitewater adventure company, which sounds really fun. And we give them 27 one-day rafting tours, and we sell these rafting tours for $6,750. So we're earning revenue. We've got revenue going up, $6,750. And these customers owe us for this, right? Because we send them a bill. So we provide the 27 one-day rafting tours, and then we bill Crystal River Lodge. So we send them a bill. So now accounts receivable is going up. All right, because now that, remember, accounts receivable is when our customers owe us money, accounts receivable going up, revenue going up. All right, company paid creditor, partial payment, worth $1,500 on account for the liability recorded in transaction C. So I don't know, I'm not going to flip back all the way to transaction C. I can't exactly remember what it was for. But nonetheless, we're making a payment on it. And just like we said before when we made a payment, this is just like if we would pay our credit card in our personal lives. Cash is going to go down. Obviously, we're paying a bill. And then also what we owe, the liability, in this case, AP, the liability is going down. All right. Company paid an expense in cash, $225. So now this one we're paying in cash. This is our utilities expense. So again, utilities expense are going up. And expenses overall decrease equity. So we think of like the expenses going up, but also because we're paying it, equity is going down and our cash is going down, right? Company paid creditor on account 620. We've already saw this, or we have seen this transaction now a couple times. You know, again, you could think about this one as just like when we pay our credit card payment in our personal lives. You know, our cash is going to go down, but then also what we owe is going down. All right, company paid expense in cash. Again, we just looked at the example with the utility expense. You know, overall, when we pay an expense, that decreases our equity. So you know, we see it says 2,300 wage expense. That's going to overall, that decreases our equity, and that decreases our cash. You know, again, that's how we remain balanced. For every increase, there's a decrease somewhere else, right? That's how we remain kind of balanced on this basic accounting equation. Okay. Company buys equipment on account for $3,780, making a cash down payment of $1,850 and charging $1,930. Okay, so equipment's going up. That's what we're purchasing. We're purchasing equipment for $3,780. So equipment's going up $3,780. We're making a cash down payment of $1,850. So cash is going down $1,850. And then we are basically borrowing $1,930. We're going to still owe $1,930. So you see the equipment going up for $3,780. You see the cash going down $1,850. We see now the AP, the liability, going up $1,930. That's what we owe now. All right, company receives cash on account from credit customer. So this is where, you know, we already provided the service, the Whitewater Adventure, for the customer. We already provided the services or the service. Now the customer is just making a payment on the account. So the customer makes a payment to us, our cash goes up, and then what they owe goes down. So they no longer owe us $6,750. They made a $2,500 payment on that. So now they only owe us $4,250, essentially is what that's saying. Company sells services for cash $8,750. So this, you know, again, we're earning revenue. So we're earning revenue of $8,750. When we earn revenue, that increases owner's equity. So we're earning revenue $8,750, and we sold these services for cash. So cash is going up $8,750. All right. Owner makes a cash withdrawal $3,500. Okay, so this is an owner drawing. And remember, like we said, when the owner withdraws money out of the account, that decreases equity. So that's overall, that's a negative to equity. So we have the owner's drawing here, $3,500, and then that decreases our cash $3,500. All right, at this point, we would stop and we would work on problem 1-1B together. And I am just double checking, looking at the book right now. 1-1B, yeah, we're going to do 1-1B in class together. So we will get practice with that. But again, you guys have problem 1-1A, which is just like 1-1B, but a different company, different information. You guys have problem 1-1A and 1-3A for your homework. So you'll get practice with this as well. So, all right, that is the end of the PowerPoint. Hopefully that helped with understanding on the chapter. I think that, you know, if it was me and I was kind of always a little overzealous and, you know, kind of wanted to cover all my bases. If it was me, I would read the chapter and then I would view the recorded lecture just to get a little bit more information and a little bit further analysis on it. And then I would practice the exercises for the chapter, make sure I felt good about it. So anyway, as always, just let me know if you have any questions. You're welcome to, of course, get a hold of me any way that you see fit, whether it's through email or through text message or we wait till we meet together. So I'll see you guys later. Bye-bye.